I have brought Larry Goldberg on again, even though he was just on last night. I mean, Larry, we could call this the Randy and Larry show now, I think.
Yeah.
I just want to know which one of us is Manny and which one of us is Mo, or I don't know. So many different groups that we could be compared to, I suppose.
Yeah. Yeah. Matt and Jeff,
Mud and Jeff would be a real possibility, I think.
Abbott and Costello.
So, what we're going to be doing today is our monthly foray into the world of Cathie Wood, who we both appreciate as a scholar and a gentlewoman, who each month provides a lovely set of slides where she tries to explain the economy to us. Not only what is happening and did happen, but maybe a little bit about what we could expect as a result. And then you and I try to add moments of wisdom, possibly.
And I really think we should tell everybody watching is that if they want to get the real McCoy, they should watch Cathie doing it because she really has, an excellent way of putting it, and she really makes things a lot clearer than perhaps we may do it. We may obfuscate it. The other thing is we put our own spin on it.
We do. We
Spin
do.
may be a little bit more informed than ours. So
I don't know. Anyway, she is cuter than us.
she is.
You can combine our cuteness, and she's still cuter.
Yeah. I'm not sure how much we subtract from each other, but the total subtraction is, I mean, the total level of cuteness is quite negative.
All right. So I'll let you take it away, Larry, because this is really your show, and I'm just along for the ride.
I don't know. I think you bring as much as I do, certainly. Anyway, let's start by let me share my slides if I
Yep.
can find the share button. If I can find the share button, and it's here. And yeah, just tell me if it's all good.
It is wonderful.
Wonderful. I don't know about wonderful, but as long as it's good, if it's good, it's good enough. Let's see. So Cathie starts by giving us some background, and the background is quite extensive this time because of the new administration, because of our friend Trump becoming the president. So we've got a lot to talk about here in terms of the background. So the overwhelming fact of life right now is the Doge.
Right.
The Doge is in action, and they're busy, and Trump is doing this buyout, and the administration is moving swiftly. Tariffs are in negotiations. So to start with, we're talking about the deficit and Trump's attempt to arrest this incredible growth of the deficit since the pandemic. I mean, we weren't in great shape before the pandemic, but with the advent of the pandemic, Trump first took very, very, rapid and emergency action to save the economy. And then when the Biden administration came in, right in the midst of that, they decided to up the ante and double down, which I think was a terrible mistake. And they did it with a very heavy hand. And they added to it the so-called Inflation Reduction Act, which was an Inflation Increase Act. So by doubling down on the pandemic emergency spending and adding to it the Inflation Reduction Act, we saw a burst of inflation that followed classical economics. So Trump is acting very, very vigorously to defend against that because we are on an unmanageable path. And it's a path that, if we get much further down this path, there's no coming back. We're Argentina. All of a sudden, we're Argentina, and we'll see, a huge spike in inflation. I mean, the Federal Reserve can do a good job to keep it down, but at a point in time, even the Fed is going to run out of ammunition. And suddenly the dollar is no longer going to be, trusted. And at that point, it's not even a problem of an Argentina type situation, but because we are the reserve currency of the world, when the dollar starts sliding, uncontrollably, then the whole world economy is, we're in a 1930 situation or worse. So, and I like to add that color to it because a lot of people don't understand just how serious the problem is.
Right.
They all say, the deficit's bad. But we've been saying that for 20 years. This is not, in 1990, we actually got to a point that the budget was balanced.
Right.
But in the 35 years since, we've not only slipped into deficit, but in the last couple of years, we've slipped into extreme deficits. So the Trump administration is moving with vigor, and I think it's not too late. I think they're doing a hell of a good job. And Cathie listed, the DOGE. She listed the buyouts that Trump is trying to do. 60,000 people have already signed the buyout from the administration before the halt. A court imposed a temporary halt. I don't think the court will be able to halt it.
No.
I think ultimately it will go through. And Trump is aiming at 100,000 people, but people have to understand that 60,000 people is not the issue. The issue is that every person that resigns represents not only themselves, but the contractors that support them. And so the impact is much more than the 60,000 people. It's possibly 2 or 3 times as much as that. And so the administration is moving swiftly on multiple fronts. They're looking at tariffs to replace some of income tax. I don't think it's possible, and I don't think tariffs are an ideal way for a government to earn revenue as a revenue source. Cathie talked about it as if it's reasonable, but I don't think it's reasonable for a lot of reasons. I don't think tariffs are the way to fund a country. I think tariffs are a great negotiating tool. I think they are an important method of keeping people disciplined about their trading policies, particularly the Chinese and our border colleagues of Mexico and Canada, as far as behavior is concerned. But I don't believe they're a revenue source. Cathie talked about them as a credible revenue source. I don't believe they are. We're told that they were a revenue source before the 1914, and particularly in the previous centuries. But government has grown far beyond what tariffs could support. That's for a start. And the other is they tend to impact trade very heavily. So for those reasons, I don't really believe tariffs are a good source of government revenue.
Yeah, Larry, one of the things you've probably studied this as well, because there was a couple of books written about it a few years ago that everybody was interested in, and it was the concept, and I'm forgetting the darn word that I want as the headline on this, but where you get a little bit here, a little bit there. You don't have to get like in a business, people concentrate so much on sales, and then they don't concentrate on the cost of goods. They don't concentrate on the overhead. They don't concentrate on collecting their money faster, et cetera.
Yeah.
So if you go in and you get 5% from everything, all of a sudden it adds up to real money, as opposed to trying to get all 100% from one thing or 50% from one thing. So
That's
in
true.
the case of tariffs, maybe it only becomes 5% of the additional revenue that comes in, but it becomes meaningful at that point.
That's right. I mean, they're not looking to replace all of income tax,
Right.
but they're certainly looking to fund part of the deficit. But tariffs do have a downstream impact, and there's a whole theory about it. I don't want to get into it right now, but
Right.
economists by and large don't really, set a great store in tariffs. And then there's the issue of deregulation, the potential for deregulation, with 10 regulations to be removed for everyone. This one, I think, is very important. I really do believe that regulation is a cramp on the growth of the economy, and economic growth is one way to offset the deficit. I mean, why do we want to reduce the deficit? We want to reduce the deficit so we don't threaten the dollar.
Right.
Why do we not want to threaten the dollar? Because we want a robust economy, and we want an economy that's growing. We don't want to be, we don't want to have to cramp the economy in order to collect taxes, in order to pay our debts.
Right.
So deregulation is a way to increase the growth rate of the economy. And regulation is a very clear cause of stalled economic growth.
Right.
So we want to be focused on spending faster, including in defense. The defense is going to have to go through a massive change. And we could do a whole separate program on defense because we really have a serious problem. We are armed for the wrong war right now.
Right.
And markets beginning to react positively to proposed changes. That's Cathie's view. I think the market has been very, very robust since Trump has taken over. We've seen a jump in the market, and it wasn't exactly low at the time. So I think the market is well set to grow significantly, particularly if Trump pursues these policies. And he feels pressure to work quickly. And this is a very important point because potentially within 2 years, he's a lame duck. In fact, even within a year and a half. However, I really believe that it's not a Trump administration anymore. I think it's a Trumpist administration. What I mean by that is that I think he's set the pattern. I think he's set the philosophy. And I think the philosophy is smaller government, less intrusiveness into private lives, less intrusiveness into the economy, and less government expenditure, a balanced budget, and a much more, a much less ambitious foreign policy. And I think that all of those things will add tremendously. And it looks to me like the Republican Party are signed on to this for the long term. So it could be that this is a longer term process that, is going to survive him, particularly if the current administration, if the next president comes from within this party and the current administration. And then emphasis on new technologies and defense spending, that really goes back to that point in defense. Right. I think those are the important points that Cathie, presented during her presentation. And I really urge everybody to, if you can't sit through the whole thing, go and listen to Cathie's introduction, because I think, it really is quite brilliant in terms of its assessment of the future, even though I'm not necessarily 100% aligned with her on everything. Right. So she starts with monetary policy. Any comments, by the way?
No, I commented when I thought it was necessary, yes.
Okay. So as usual, she starts with this analysis of the budget deficit or the surplus percentage of nominal GDP. So real GDP versus productivity is what this is all about. And so what we're seeing is that, the administrations are licensed to cut spending and streamline government, and there are various strategies she can use. They can cut they can use. They can cut spending. They can change the tax, or economic growth, or a combination of the above. And the objective of the administration is to reach a negative 3%, a 3% deficit, in other words, relative to GDP. She feels that, or the administration feels, if they get to -3 instead of, it's currently -6,
right,
and it may even be larger than that by now, but there is certainly -3. And if they can get to -3 and hold that line, then economic growth, will offset that, and I think we'll be in a very good shape. And so there's potential for even lower deficits if growth accelerates.
So
And
we talked about this for a minute last night, Larry, but let's say it again, is that
yeah,
the way Musk is talking about it, I think is even better than the way Trump is talking about it. So if we get the deficit cut and we get the regulations cut, the interest rates will come down because the bond market will say, okay, we don't need we now believe you, and so you'll see treasuries start to come down. As treasuries start to come down and you have the government getting out of the way, the economy, Cathie thinks, might even grow above the 2.0 to 2.5 that has kind of become expected. She thinks it might even grow at 6% given all the innovations that are coming. Uh,
yeah, we're going to look at the growth that she's projecting, and it's pretty high. It's
right.
very, very high.
But even if we got to 3% growth or 3.2, 3.5% growth, that's going to create more revenues coming in on the income tax side. If you get the income tax revenues coming up, you get the interest rates coming down, which further cuts the budget because the number 3 item in the budget right now, I think, is interest. Maybe it's 4. Number 4 is interest. So you got the interest rates coming down. So I think what Musk is after now is a balanced budget. He's looking
Yeah.
at, because of all of those interacting parts, he thinks we
Yeah.
might be able to get to a balanced budget.
Yeah. I mean, let's put it this way. Elon Musk is the genius of the potential. He doesn't always deliver to the full potential, but that's his North Star is to look at the best possible, the best practical possible outcome and shoot for that.
Right,
And even if he falls short of that, the results are magnificent.
right.
So I think, we have to balance, his idealistic view of the future, Trump's probably more practical view of the future, and then the real possibilities. So it's very important that we see growth of productivity because growth of productivity really drives GDP growth, as we see here. The real GDP growth really mirrors, to a large degree, the growth of productivity.
Yes.
And we'll talk about that in much greater detail when we wrap up, by the way. And then, there's this whole discussion about tariffs. I've already said my piece on tariffs.
Mhm.
The blue line here over the years from the 1790s when the union was formed, we see the tariff revenues coming from that source. And we see the tariff revenues replaced by income taxes over time. And we'll see that, in the war, of course, it reached very high levels. And then, we have kind of just gone back down to like 60% as the source of federal receipts as a kind of norm from individual income taxes. And the tariffs have brought in very little. But there was a time when the tariffs were bringing in, 90% of government revenues,
Right.
and then 50% of government revenues, which is the big break around about 1870, right? And that was the result of a, very, very significant recession. So, what we're looking at is, can this be replaced by this? And I have to say, I'm very skeptical,
Mhm.
very skeptical.
Mhm.
And I'm skeptical on quite a number of bases. The one is the impact on inflation. The other is my experience is that it's very, very difficult to get a government to give up a particular source of revenue. And if you establish tariffs as an income revenue stream, the next government, or ultimately a government, is still going to keep those tariffs, but drive income tax up and even drive
Anyway,
tax.
yes, right. Yes.
So
That'd be a good reason right there alone. Yes.
so I prefer the Musk approach. I prefer paring government back down
Right.
and implementing government policies implementing, long-term policies to keep that down. one of the ways to do that, in my view, and could be the subject of a whole nother conversation, is to implement the Constitution. Return Congress to its job and return the executive branch to its job.
Right.
Right now, the Congress has grown its role well beyond, passing laws. They've gone into the actual, they've really invaded the president's space, or they've allowed a bureaucracy to invade the president's spaces by creating all these so-called independent agencies.
Right, right.
And so I think that the Supreme Court has got a job to do to solve that problem. Anyway, let's move on.
Okay.
So real GDP versus productivity, I think we understand what that is all about. Right now, the current rates for both are about 2 to 2.5, both the growth of GDP and the growth of productivity. There's a potential short-term dip because of uncertainties. Cathie says this slowing money velocity could impact growth. We're going to talk about velocity of money in a bit. It's a favorite subject of mine. And productivity gains and strong dollar as anti-inflationary forces. So real GDP and productivity mirror each other because GDP growth is really largely a function of productivity.
Well, it's productivity plus inflation.
Well, real GDP growth is
real
not
GDP. I'm sorry. You're right. I forgot the word real, Larry.
Real, yeah. You got to get real here. So I don't know why this is a repeat of the same graph, but strong dollar combined with productivity gains, powerful anti-inflationary force, market fears about inflation reigniting may be misplaced. So we'll see. The market fears about inflation reigniting, I don't think is real, but, we've seen inflation creep up a little bit, and that's the reason the Federal Reserve has kind of stepped back on the number of interest rate reductions that they're making. Now we're looking at the yield curve. So the yield curve is a little complicated, but it's the difference between the 10-year Treasury and the 2-year Treasury. 10-year Treasury being longer duration, you'd expect a higher interest rate. 2-year being a shorter duration, you expect a lower interest rate. And you always expect the ratio to be, 10-year as a sort of a higher rate, and therefore a positive differential to the 2-year rate because it's a longer duration. Well, we know historically that if this is the 1-to-1 ratio or the parity ratio between the two, that when the 2-year increases above the 10-year and the 10-year slips below the 2-year, that reversal generally leads to inflation. These gray bars are inflation over time. So if you look back all the way to 1980 and even before.
I think the gray bars are recessions.
I mean recession, what did I say? Inflation. And whenever we slip below the zero line, generally it follows that we have a recession. And we see that it's been fairly consistent, very consistent, except this time where we really did slip and quite badly and for a very extensive period, may even be an almost historically long period.
Yes.
There was this long period back in 1980, but it was interrupted by the sudden burst, the sudden reversal. And I'm not sure which is longer, but it was a very long time.
It was a very long time. Yes, it's like 19 months or something. So Larry, the other thing that's interesting is that if you go really close attention, you notice that the recession actually starts after the inversion flips.
That's right.
And you and I learned all about this. I don't think I knew anything about it until 2 years ago, but Cathie instructed me. So I've been watching this very carefully on a daily basis with my reporting at night and in the morning, actually.
Yeah, we do it every night. Yeah.
Every time we talk about it. And what we've got now is we've got that flip. It's flipped back. And yet nobody seems to think that there's any recession anywhere in sight.
Well,
So
we've talked about this at length, and the fact is, I do believe that we've had a recession in a very large proportion of the economy. But if you look at the economy, there's this, this golden sphere of activity around high tech that has kind of been a powerhouse
and government spending.
and government spending. Yeah. And if you box that off, and healthcare as well, if you box those off, all the rest of the economy, I believe, has been in a recession.
Housing,
Particularly
housing, auto, small business, transportation, all in recession. Yeah.
all in recession. So I think that's been the difference this time. So you get this kind of distortion. And it often happens. You get these distortions that don't force the overall economy not to comply with historic norms. But it was very uncomfortable.
Yes.
Small business person. It was very uncomfortable for the person in the street, and it was very uncomfortable for lower income labor.
Yes.
It was as uncomfortable as a real recession.
Yes.
So, that's the important takeaway. And so, the question is, how are we doing? And what Cathie says, that, the declining slope in the yield curve over the past 3 years, the recent flip, the potential for future steepening before resuming a downtrend. And so she thinks that this line is going to go up further, that, the long-term interest rates are going to go higher, or the shorter-term interest rates aren't going to go as high. Fixed income market may be sensing deflationary undercurrents. Historical comparison to the late 1800s, early 1900s innovation period. So this is very important. I don't want to skip over this, and this really will hark back to this at the end of the presentation. But you've already put the point that this whole innovation, this world of innovation, which has kept, by the way, high tech, buoyant in the last couple of years, despite the recession, is going to be a driver for the whole economy. And it's going to be very important in terms of a positive result in the economy. And there's expectations of a downward trend due to deflationary nature of current innovation. So, prices are being driven down by this innovation. So that's the deflationary aspect of this. So it's a very complicated world. We've been in a situation where it's been less easy to predict the future than in the past, and it was never easy to predict the future. And then money supply. Now, we do know that money supply drives inflation, and we see that M2 growth, that's money supply that we measure for inflationary purposes, growing at 3.9% year over year, which is high, and it indicates, a 4% plus inflation rate. The purple line, M2, tends to lead inflation. So this line is, where we are today, and it tends to show that in 2 years' time, almost 2 years' time, there'll be inflation because it's above the zero line. And current inflation stuck in the 2.2 to 3% range. Fed is aiming for a 2% inflation. It's come down, but it's a little bit elevated right now. And we expect 1 or 2 rate cuts this year. I don't know that we're going to get rate cuts. I think it largely depends on what happens after this Fed governor retires in, when is it, July?
Next July, I think. It's
Next July. Yeah, I think he's going to be very reluctant to reduce the interest raits.
Well, I've taken a little bit of a deep dive. I can't say it's a real deep dive into Milton Friedman lately. And the interesting thing, because we were basically running our money policy, our theoretically, we're running our economy based on Friedman
No,
approaches.
no, we were running the Federal Reserve based upon
The
Friedman.
Federal Reserve,
We
yes.
were running the government based
Yes,
upon, yeah,
yes, Keynesian, yeah. Theoretically, though, instead of the using the actual inflation and using the unemployment numbers as the way to judge or the way to manage the economy, Friedman said you should be managing this one. If you keep them, you should be managing the money supply as your key thing that you manage in order to keep inflation at the 2%.
right, right. The inflation will determine the employment,
Right.
you know,
Exactly.
the employment dynamics. And then, the most amazing number I saw this year was this new tenant rents. And if you look at new tenant rents, which is this purple line, they indicate they've gone negative. Look at that.
Right.
So new tenant rent, the percentage, the rate at which they're earning is now gone, negative 3.5%. That's an enormous drop. It's an enormous drop. I just look where it's gone. It's gone from 12%, back in 2022 at the height of the pandemic, down to minus 3.5. And so we saw the same negative trend in the housing crisis. And the reasons for the decline, new rental units are coming onto market in massive
Mhm.
numbers. Result of construction boom after the 2008, 2009, private equity investment in real estate, private equity seeking returns. Indicator leads to other rental inflation measures. It leads other rental inflation measures and expectation of further declines in rental inflation. So this is rentals, and this is the reported rentals from existing the historic numbers in existing homes, and this is rentals for new rentals, and you can see
Yeah.
it's collapsing.
So again, I think she made a mistake in not commenting on this. This is yet another distortion created by COVID and the aftermath of COVID.
Right.
Shortage in rental units, and the mass immigration. So we've never seen mass immigration on this scale ever.
Yeah.
And then in addition, we had the COVID and the aftermath of COVID, putting more money in people's pocket after the COVID, which resulted in people being able to bid up the rental prices in a time when there was no availability. There was no new rental housing coming on board. So when you have this mass, you can see the swing up is really extraordinary also. So,
Yeah.
so when you have a swing up like that, you're going to expect a response. You're going to expect it to rebound. You're going to expect smart money to go out and chase new apartment units. So they built a lot of apartment units. Well, now they got a lot of apartment units coming on strong. So the rents start to go down. But then what happens is now you stop the immigration coming over.
Yeah.
So
And you reverse it
you
somewhat.
reverse it to some degree.
Yeah.
So
By the
yeah,
way, I will contest your point that we've never seen such mass immigration. In relation to our population,
oh,
we've seen that before in the 1890s to the
okay.
1900s.
And it worked, and it turned out very badly.
I
Turned
don't
out
know
so
about.
it turned out so badly that I forget which administration it was. I want to say it might have, I can't remember which president, but it was so bad that they completely stopped immigration. They said we can't take any more, we can't absorb the different cultures this fast, and they completely stopped all immigration. I think,
Right, but when you say it turned out badly, it may have turned out badly politically, but economically it turned out very well.
yeah, I don't
Because
know
it led
about
to it led to the huge boom in the early part of the 20th century before the
yeah.
1930 collapse. It is the labor that supplied the massive growth
Mhm.
of the new industrial revolution, of the third industrial revolution in the
The
United
bad
States.
part was the culture and political parts of it.
Yeah, yeah,
Was
exactly,
hard to
exactly.
manage. Yeah, yeah.
Which is what is killing us right now.
Yeah, right.
Velocity of money started to roll over so velocity of money is the thing I always get
Right.
onto. And, we've seen the velocity of money went right through the roof in 2000. It collapsed in the 2008, it was a 2008 crisis. It recovered a little bit when the bank, uh, pumped money into the system, and it's declined ever since. It reached a nadir in the pandemic, and it's risen again, but it's not very high at all.
No.
It's not very high at all, and it's one of the reasons that inflation has been contained.
Yeah. This is
And
this
it's not showing a propensity to drive itself upward at all.
this is extremely interesting to me. When I saw this earlier, it bears more study. How can the velocity be this much lower on a sustained basis? Is it because of, I don't know what it's because of, Larry.
One of the reasons is because of the large amount of government uh, participation in the economy. So the
Larry,
government
Larry,
class.
Larry, I'm going to have to put us on pause for just a second. All right.
So we have to watch the velocity of money very carefully in the coming couple of months. But I think that the velocity of money indicates to me that inflation is done. But it could be something unusual happening that I'm not aware of.
Okay.
All right. So consumer sentiment, University of Michigan. Well, it jumped up a lot at the election, after the election, and it's kind of moderated a little since, but it's still a long way from, where it was and where it should be at, the level of confidence. So right now it's still at the bottom, it's come from the bottom the middle of last year, but it's not anywhere near where or last year actually, it's not anywhere near it should be. And Cathie thinks it's fear of tariffs and concerns about rising prices.
Yeah, and that's what the report showed in detail, and also the consumer confidence report, which also came out last week, showed the same trend, but it was a 1 month trend for both. So this may or may not continue. I think it's reasonable right now for consumers to be a little nervous about all the tariff talk. Uh, uh, Prior to this, I think they were less nervous, but when the tariffs start actually being not just threatened, but then imposed and then pulled back, and then more talks of other tariffs, I think the consumer being a little nervous about it does make sense.
Yeah. So the year ahead expected inflation rate, it's gone up quite significantly. It jumped to about 4.3%, which is quite alarming, really. And factors are the fear of tariffs, the rising egg prices because of the bird flu. Apparently, that's a big deal. I wouldn't know. I don't buy eggs, but apparently it's a big deal. Um, and the recent turnaround in gasoline prices. I think gasoline prices are going to drop from here on out.
They will,
I think,
and they didn't go up very much. Uh,
yeah.
and oil prices since then have come down 25%. So I think we'll see this. I think this will be a 1 month data point. I think this will look a lot different a month from now.
Well, it depends on how the tariff war goes.
Right.
Then the unemployment level. So trend of permanent job losers are still up despite recent decreases and continuing monitoring required. So, we're at a point where permanent job losers are not, I mean, it's not bad really. It's up, but it's not bad. So I don't know. I have a whole set of slides that we can deal with when we've got more time. We've got a lot of stuff to get through now, but I've tracked the trend of how we missed on unemployment reports over the last year or two, and you'll see that we were constantly overestimating employment.
Right.
And now it's reversed. We're overestimating unemployment. And so that indicates these monthly reports when they do the estimate. And so that looks like the trend has been reversed, you
Right.
know. So I think historically, when you look back historically, we'll see a very significant change in what we thought was happening versus what was actually happening. Cathie also used auto sales as a proxy for economic activity or not only economic activity, but also the view of the public. And here it's interesting. She sees, this little blip just in the last month or two, and it's back down again. And she sees this as being normal for, a confident economy. But to me, it looks like it's very short-lived, these 18 million or 17 million car sales, and that for the most part, I would say this is more normal and we're close to normal. I don't think seeing really the effects yet of full self-driving or autonomy, and we're not seeing the effects at all. Uber is not really, I don't think Uber's having a real dent in the car ownership situation. If it is an impact, it's hardly visible in the numbers, but I think this number is going to plummet.
This chart is probably a really bad chart. It doesn't show it in terms of population. It should probably be number of cars sold based on population. So you would tend to believe that if your population is going up 3% a year, your car purchases would go up 3% a year.
Yeah, but it's the age of population as well, Randy.
No, I agree. I'm not saying there's not other implications. I'm just saying
Yeah.
over the period from 1980 on this chart until 2025, you've got a tremendous increase in the total driving population. So you would, in general, expect more of an upward trend in car purchases. But what we've had in that same time, I'm sure you remember, Larry, when we were kids, you never kept the car past 90,000 miles. There was just no chance. The teenagers bought the cars that had 90,000 miles and drove them until they put them in the junkyard at about 210. Now you don't even think about a car. They're going to get you 150,000 miles. So when you get that much more mileage out of your car, it's going to have a big impact. Moreover, we went in the 70s and 80s, we went from one car per family to 2 car per family. That had a big impact. That's no longer going to be a trend. If anything, that's going to reverse. So big changes that are not really showing up in the chart, but in the short.
Well, there are other changes that you haven't factored in.
No.
There's a very large population of young people who no longer drive or
Right.
cars, and the other is there's an aging population.
Right.
And so when you add those two factors in, and we've had an enormous increase in immigrant population that don't buy cars. So it's really hard to actually parse this all out. And I think this is a bad proxy
Yep,
for confidence levels.
I do too. Yep.
Existing home sales, however, is not a bad proxy. It's a great proxy. And we're looking at existing US home sales, and we're really down at the low points. We know that 2008, 2010 crisis reached an absolute low point. We're almost down at that point where there's been a small recovery, but not much. So current levels are much lower than the 5 million plus seen in the late 70s. Many homeowners are trapped by high mortgage rates and the administration focusing on long-term interest rates to address the issue. I don't think we're going to get anywhere close to those rates, and people are finally going to bail on those interest rates, I think.
But we'll never see the kind of turnover in homes that we used to see because people don't move as often. People used to move, the average, I think, was once every 5 years. Now I think they move an average of once every 12 or 13 years or something.
Never say never.
Never say never. There you go, Larry. Of course.
If Cathie is correct about the coming revolution in as we move towards these technologies and we see this productivity revolution, we will see a resurgence, a huge resurgence of ownership changes and moving.
Interesting. Interesting.
Yep. And then we're looking at US net income, non-corporate divided by corporate. What is this? This is small businesses compared to big businesses.
Meaning small businesses under 500 employees.
And when we see this number down, it means that small businesses are really, their income is really down compared to big businesses. All big businesses' income are very high compared to small businesses. Either way, we are at an all-time record low.
Right.
All time.
And again, the industries that are in recession are heavily small business. So you've got housing, which is small business. You've got transportation or trucking, which is small businesses. You've got, what do you call it? Small business itself. And you've got manufacturing. All of these, lots and lots of small businesses in these categories. And they've been in recession now for 3 years. I mean, abject recession.
We haven't in 50 years seen anything like this.
This is amazing.
Yeah. So if you talk about recession, this is the recession.
Right.
And then we're looking at 10-year US Treasury yields. We've looked at interest rates quite often, but when we look at 5% yield as being the quote right yield, we really can see that we're at about that level right now. So the US 10-year Treasury yield, Cathie is saying, is reasonable at this point. And she says as a result, the potential for an inverted yield curve to become more mainstream. In other words, we may have changed the economics and we may be faced for a fairly long period of time where the short-term interest rates may be higher than the 10-year Treasury.
Yeah, of course, I'm expecting the 4.5 that we're now bouncing up against to be the absolute high, maybe for another generation because of productivity. So I'm anticipating that we're going to 3.5 within the next 6 months on the treasuries, and then that might become the new normal.
Yeah, I think it may take a lot longer than that. Things always take longer. In economics, things always take longer. So this is the corporate high yield spread over 10-year US Treasury yield. So this is the difference between high yield bonds. What is a high yield bond? It's a bond of a company that doesn't have a great credit history, like Twitter. So high yield bond spreads are near the low end of the range. In other words, very risky bonds are not that much more expensive than really good bonds. And that's what this means. When you see it rise, it means that high yield bonds are reaching very high levels of difference between them and high grade bonds. So it contrasts with the high spread seen during the 2008-2009 crisis. So where you see that Elon Musk's bankers sold off their debt at 98%, which is functionally not a discount at all. In fact, it's par. It's functionally par because of the time scales that they've held it already. It means that actually, what was considered to be a low-grade bond is being sold at market rate right now, or at the market rates we had 2 years ago.
So what we have here, though, Larry, is a couple of other things, and one of those would be this could mean that there isn't a lot of demand for these junk bonds, and I think that's probable when you've got these, when you've got the smaller businesses not doing so well. So they're not going to go to the bond market looking for expansion money when they're not doing well. The other thing that could be going, and the other thing that would be good news for those folks is that when they do get around to wanting to expand again, they will have this opportunity to actually get decent rates, which will be
Right.
really positive.
That is a great positive. So this is Cathie's favorite slide. She gave it short shrift this month because really I think it continues the same story. But basically, this shows you that commodities over the last 50 years have remained flat, the same levels as 1980s and 1890s. And so this whole idea that commodities always go up is just not true. And so the commodity prices have remained absolutely static, with the exception of, these wild times in 2000, going towards the global financial crisis.
So Larry,
And
I did a little more deep diving into this because I'm very fascinated by commodities as well. It turns out that this is an area of productivity. This is an area of
yes,
innovation that is keeping the prices low. Is the cost to extract minerals, the cost to create farm foods, the cost to get oil out of the ground, et cetera. All of these costs have been going down dramatically. The cost to distribute them has been going down. So that's why we've been able to keep the commodities under control.
that's correct. But that just shows you that technology is anti-inflationary.
Right.
I mean, it's just a function of technology,
Yeah.
right?
Mhm.
So it's very important, and it also speaks to the misconception that the world is running out of
Right.
the commodities.
Right.
I mean, there's almost boundless capacity of the earth to supply us with these commodities, and we're not going to run out.
No.
If Ehrlich and company had been correct, somewhere around here, the world would have been starving.
Right.
But the world population has grown 3 times what Ehrlich was scared of,
Yeah.
and yet commodity prices have remained low.
Right.
And then the metals to gold ratio. This is the most perplexing slide of the lot, and that is the metals to gold ratio for a long time has remained fairly consistent. There was this time between 1980s and 2000 where even though the trend was the same, it wasn't quite aligned.
Yeah.
But really in the last 50 years, 40 years, 30 years, the the metals to gold ratio versus the 10-year treasury yield has been consistent. But notice now the 10-year treasury yield has gone up very significantly while the metals to gold ratio has gone down. I I've watched Cathie do the slide for years now,
Here's
actually.
now. Yeah.
Yeah, ever since the pandemic. And it's not clear to me what the slide is teaching us.
Yeah. Yeah. So we know that the 10-year treasury is too high. It's high by historic standards. Compared to inflation, compared to everything else, it's high. We also know that gold is high, very high. Gold is on a tear. It was one of the best investments you could have made the last 2 years.
And that's a function, I think, of BRICS trying to use gold or China trying to use gold as a substitute for the dollar. China and Russia.
Right. And a lot of consumers also getting into gold because of
Right.
whatever, lots of reasons. So it's a very, very, and we know commodities, metals are staying flat. So
Yes.
I agree with you. This is a weird chart. It's interesting that it was parallel for so many years, but I don't know. It'll be interesting to continue to watch what happens with this one, but I'm not sure, like you, what it's teaching us.
Yes, and I'm just wondering whether crypto is going to replace gold in due course as a source. So anyway, who
Yeah,
knows?
yeah, yeah.
But it's not clear to me that this is telling me that the gold price is too high or that the interest rates are too high. I'm not sure what it's telling us. I don't think there's going to be a reversion to the mean for various reasons
Yeah, yeah.
that we've discussed. And then S&P 500 price to gold ratio. And here again, I would say roughly the same thing, that the gold price, gold has gone through several distinct phases. And I think we entered a new phase when, the Ukraine war started, and when Trump became president in 2016 and confronted China and changed the rules with how we deal with China. I think from that point onwards, the price of gold entered into a new regime. So I think I'm going to take a different view to Cathie here. I think the two are not really related because gold is changing its place in the economic firmament. And then we look at S&P 500 price to WTI crude oil. It's interesting that it's showing a very marked upward trend. And Cathie thinks the expectation is that the trend is going to continue, that the S&P 500 is going to continue rising against the oil price. And she says that the shift to electric transportation or increased nuclear energy adoption. I'm not sure that's true. It could well be also, non-oil based, say wind and sun, solar power. So that could be a function. I'm not sure.
You might be talking about that partly as that shift to electric transportation. I would say that there was a period when, as we know, not only in the United States but worldwide, people were moving away from oil, but the oil companies were finding more and more of it, and finding cheaper ways to extract it in order to stay relevant. And now there's a massive amount of oil, just mass. The United States has more than Saudi Arabia. Venezuela is sitting on, some people think, the largest reserves anywhere. And that doesn't count the stuff that hasn't been found yet. And I agree with Cathie, nuclear is going to be a very big deal within 5 years. And so I think oil will be abundant, but cheap.
Yeah, I think, by the way, I know that everybody says US has got more oil than Saudi Arabia as an indication of how much oil we've got. That's not a factor at all. I don't know why we even reference it, because the value of Saudi Arabia's oil is they do not actually consume any of it.
Yeah, right. Yeah.
We consume a huge proportion, in fact, all the oil we produce.
Right.
That's a big difference. So
net we do, yes.
So the Bitcoin to gold ratio, well, it looks like Bitcoin is,
Winning.
actually running ahead of gold in terms of its rise, even though gold is rising. But, this could be an indication that the era of the dollar may be reaching its nadir if Bitcoin really becomes a currency or really replaces that of a currency.
Yes, our buddy CERN Basher would say that the Bitcoin is the best thing, the best asset you could have owned over the last, I forget, 15 years or something.
Yeah, for sure. I mean, at the current price, it's true. But of course, next year
It could be. Yes.
it could be $10,000, not, $1 million. I mean,
Yeah,
it's
yeah.
it's
Very
amazing
very
how,
volatile.
how dynamic that is. And then we get to really what amounts to the forecast that forms part of the whole of 𝐒𝐮𝐲's, basic existence, and that is the issue of innovation.
Right.
Now, this slide is a little misleading because it's very hard for the human mind to understand a log ratio, but what we're looking at is, the growth, a real GDP growth over the last 100,000 years. And you'll see that, GDP growth grew very slowly while we were hunters and gatherers, and even when we started farming. And then it picked up a little bit. Well, it actually was down for, for a while, and then it picked up in the 1500s after I guess, the Renaissance. And then in the 1900s, with the first industrial revolution, it picked up quite significantly. 1900 picked up significantly. So this was the Renaissance. Then it picked up considerably, and then it's a log ratio. So even though this is 3% growth for these years, this is 7.3% growth here in their forecast between now and 2030. So if you think of the Industrial Revolution here, and then the second Industrial Revolution here, well, the second and third Industrial Revolution here, this is the fourth Industrial Revolution, which is by far the most dynamic of them all. IMF is forecasting 3.1% growth and this is global growth, by the way. So if the ARC is forecasting 7.3% growth globally, you can imagine the United States would be in the 10% plus range.
Possibly, Larry, but the other side of that is that I think, since she's talking about global, India, Indonesia, Malaysia, these are very populous countries that could go through the China kind of growth. They could be looking at 10 to 15% growth over some of this time period as they leapfrog the technology and they don't have to go through all the things that the United States had to go through to get where we are. So the leapfrog effect could be huge in some of those other South Asian areas where the populations are massive.
Well, we had that in fact in the last couple of years with China, right?
Absolutely, yes.
China was one of the leading growth. Anyway, time will see. Time will tell. I think that innovation could well happen, and that their forecast of 7.3% could well happen. That we're about to go through this huge technological revolution seems a given to me.
Yes, yes.
And their projection is that it's based upon robotics. Of this, I have no doubt. Energy storage. I would replace the word energy storage with energy revolution. We're going to go through a revolution in energy, whole new ways of producing it, and not only storing it, but producing it.
Right.
AI, blockchain, multi-omic sequencing. So I'm aligned with them on their platforms. I just would change the energy platform name a little bit.
Right. Agree.
So it's a bright future we're talking about. And here she brings a slide from the big ideas. And she says innovation should drive a momentous business cycle. Projected increase in global equity valuations, current global GDP to equity market cap ratio of about 100%, US ratio closer to 200%. That's what we talked about. The US growth will be almost double the rest of the world. Expectation of disproportionate growth in disruptive innovation sectors, and forecast of over tenfold increase in market cap for truly disruptive innovation. Exciting times.
Very, very exciting times from DC this weekend, Super Bowl tomorrow, and going forward into this disruptive future over the next 5 years should be absolutely exciting.
So, Randy, I have only one question for you.
Sure.
What is a Super Bowl?
Well, I did do a poll, though, Larry. I
Yeah.
did a poll about the Super Bowl tomorrow. It turns out that the number one thing that people are looking for tomorrow isn't the game, it's the food, according to my poll.
They're probably right. All right, young man, we've spent a lot of time together. I hope our audience has followed us. I'm sure we put a lot of people to sleep, and maybe that's the function of this program.
There you go. There'll be instead of rain on your roof, it'll be Larry and Randy talking about the economy that people use for their sleep medicine. All right.
I look forward to seeing you on Monday.
Thank you, and enjoy the Super Bowl tomorrow, Larry.
I won't be there.
It's been great talking to you.
Bye.